Hey, what's up, you guys? Welcome back. So, as you guys probably already noticed, I've been taking a little bit of a break on this channel just because there are certain things that I said and certain predictions that I made that received quite a lot of pushback, actually. So I was waiting for things to play out before I make another video because I felt like people weren't really listening to what I had to say. And boy, did things play out today, okay? So, to recap, what I have been saying is that the Fed should stop raising interest rates. And I think I've made my justifications for that pretty clear. But every video, I always get people being like, oh, haven't you seen the price of eggs? Haven't you seen the price of, given grocery item? The Fed needs to keep raising interest rates. And my argument against that, first of all, was that the Fed cannot control the price of groceries. And raising interest rates just causes people to lose jobs. So yes, although in the end you do get inflation down, you do it at the cost of breaking something in the economy. So what good is inflation coming down if you've lost your job and you have no income now, right? So that's my argument, and I think that makes sense, right? Like, people are hyper focused on the price of, eggs or whatever, like, right? And they're ignoring the fact that if you lose your job, then you have no income, then you can't afford anything. And further, my argument is that you may be complaining about the prices of groceries now, but you're not prepared for a real recession. I think maybe the 2020 recession lured people into a false sense of security where they're like, oh, I've been through a recession, it's not that bad. But the 2020 recession was not a real recession. It was like a quotations like recession, if you ask me, because it lasted for what, like 3 months? I'm talking about a 2008 to 2009 style recession, if not worse. I'm talking about something in our financial system breaking. And I think today we saw exactly that, right? Something in our financial system broke, and it's because the Fed was too aggressive in raising interest rates. So let me rewind a bit though. Who is Silicon Valley Bank, or SVB for short, and what happened? So SVB, or Silicon Valley Bank, is a regional bank that services a lot of startup in Silicon Valley, right? Which is a region in California, in case you've been living under a rock and you've never heard of Silicon Valley. So on Thursday, or I guess more accurately Wednesday night, they announced that they're liquidating their investment portfolio at a huge loss. So obviously this is bad news because you wouldn't liquidate your investment portfolio at a huge loss unless you really, really needed the cash like right now. So Silicon Valley Bank serviced a lot of startups and was pretty well known in the tech space. And the tech space, as we know, has been experiencing massive layoffs because they're the ones getting hit the hardest by rising interest rates, right? Because startups have to borrow money to fund their operations because a lot of startups, or most of them, they don't turn a profit. Anyways, as you can imagine, SVB probably took really big hits in 2022. And I would imagine that their risk management was also not as good as it should have been. The point is that they really needed the cash so badly to stay afloat that they were willing to book a nearly $2 billion loss, which sent a signal to the market that they were in trouble. So their shares plunged around 60% in one day, which then triggered a bank run. And today they announced that they were bankrupt and federal regulators are taking charge and they've stepped in and seized the bank's assets. So you should see the lines of people outside SVB branches where everyone was just lining up and waiting to withdraw their cash. So it's a literal bank run. And this is in the US, by the way, not some third world country, for lack of a better term. But it looks like a third world country, right? So if you had funds at SVB, it is federally insured by FDIC up to $250,000. However, the bad news is that most people had more than $250,000 at SVB. Because remember, this was a bank that helped a lot of startups and businesses and, just big companies and venture capitalists and whatnot. So a lot of company accounts would have more than $250,000 in cash, right? In fact, I'm hearing that more than 95% of the depositors had more than $250,000 in their SVB account. So anything above that would not be covered, and you'll have to wait for the bankruptcy proceedings. And hopefully you can, get your money out, at least a large part of it. And it's not a guarantee by any means that you'll ever get 100% of your money, right? And even if you have less than 250K and you're covered by FDIC, it can take weeks or even months for you to get your money because the process can take a little bit of time. So at this point, if you can still withdraw, please do. In fact, as a precaution, if you have funds in any small regional banks, it might be a good idea to move them to a big bank like Bank of America, JP Morgan Chase, just to ride through the storm, right? So I'm not just saying this to scare you, but shares of small regional banks such as First Republic Bank are dropping a lot. So you never see bank stocks drop this much. And as far as I know, First Republic is not in trouble or anything. And there's no like news specifically surrounding First Republic, but it's just that people are scared of small regional banks now. And I'm also hearing that many companies have part of their company treasury at SVB, most notably BlockFi, which went bankrupt, but they still have some cash to like pay the lawyers, I would assume. But yeah, apparently $227 million of BlockFi's cash was held at SVB. And as for Roku, yes, that Roku, the Kathy Wood favorite stock at ARK Invest, it had 26% of their cash at Silicon Valley. So yeah, anyways, the list is growing by the hour, and I think by the time you see this video, it'll be a huge list. And the collapse of SVB is the second largest bank failure in US history and the biggest since 2008. So I think this might be our Lehman Brothers moment, guys and gals. And I really do think that this might be the moment where the Fed absolutely do need to pause interest rate hikes. I know I've been saying that for a long time, but this time I'm being serious, okay? So things are actually breaking. I keep saying that, it's like if you're in a car, if you're driving a car and you know that the car is like an old clunker that's gonna break at any moment, and I keep telling you, hey, don't drive this car, it's not safe. And then you keep, not only do you drive the car, but you keep accelerating massively and you're just being like aggressive and really rough with it. Eventually it's gonna break, right? So it might not have broken the last 3 times you drove it, but that doesn't mean that the next time you drive it, it's not gonna break, right? So yeah, like things are actually breaking. And I know we've gotten some hot inflation and jobs data, and the chances of the Fed returning to a 50 basis point rate hike is being priced in, and it's increasing. But I really don't think that that's either an option or it's not a good idea in general. But I don't even think that that's going to be an option anymore because of all the contagion that we've seen. That's as a result of SVB, right? So the CME watch tool is saying that there's still around a 40% chance of a 50 basis point rate hike. But man, if they actually do 50 basis points, I'd be speechless. In fact, I think that the CME watch tool should price in the chance for a pause because right now they're not saying that there's a chance for a pause. They're saying that there's a 60% chance of a 25 basis point hike and a 40% chance of a 50 basis point hike. Which I don't even think a 25 basis point hike is a good idea at this point. But, the Fed will do what the Fed will do. So chances are they probably still will do a 25 basis point hike. But yeah, anyways, the fallout for this is to be seen again. And if you hear the term contagion, which I just mentioned like 30 seconds ago, this is a prime example, right? So by now we're probably familiar with viruses. And you know how viruses spread, right? Well, this is like a financial virus in the economy where if one bank breaks down, it drags down other banks and other companies. And a lot of payrolls will be missed 2 weeks from now for sure because a lot of company funds are stuck at SVB. And I keep saying it's a lot of fun to yell at the government for rising grocery prices, but you're not prepared for a deep recession. That's just, most people are not, right? Maybe some of you are, but like 90% of people, I guarantee, maybe 90% of you watching this video are really not prepared for a deep recession, and you're not prepared to pay the consequence of the Fed just jacking up the interest rate and causing a deep recession. So yeah, be careful what you wish for, guys. As to how to react to this is not financial advice, but personally, I think you want to buy stocks when there's blood in the streets. That's all I'm saying. But yeah, I wish I had better news. I'll be monitoring the situation and giving you guys an update if more updates come out. But yeah, for now, just try to survive and hold on steady, I guess. Be sure to follow me on Twitter, links down below in the description as always. And with that being said, see you guys in the next video. Bye-bye.